Welcome back. In this video I'm going to go over some candlesticks that keep reappearing on our charts. These candlesticks have names and some of them are pretty important in my opinion. So let's get started. If you're new to this course, please subscribe to this channel and click the bell button to enable alerts. You can also take the entire course from the beginning by visiting the playlist section on the channel. So a doji, a gravestone doji, and the dragonfly doji are candlesticks that have the same opening and closing prices. This means that prices open and then buyers push the prices upwards, sellers push the prices downwards, but by the time the market closes or by the time that candle closes, the closing price is exactly the same as the opening price. So essentially, these kind of candlesticks do not have any body. And by looking at this, we see that the opening price and closing price on all three of these is the same. This is a regular doji. This is a gravestone doji because it looks like a gravestone. And this here is a dragonfly doji. What happens here is that price opens and then buyers push the price upwards, sellers push it back downwards, and by the end it closes at the same level. The same thing happens here. It opens right about there and then sellers push the price downwards. There is a struggle, buyers push the price back upwards, but no one is really able to succeed and price closes at the same level. So this basically represents indecision in the market. And it's very difficult for us to say whether prices are going to go up or they're going to go down. Therefore, in general, this is a neutral candlestick, which on its own cannot give us any direction as to where market prices are going to go. However, if let's say prices were going up and then we see a doji, it kind of suggests that previously the buyers were in control and now their strength is fading. So a doji appearing after a sustained upwards movement can signify that prices may start moving downwards. And the same goes for a doji that appears after a sustained downward move because it signifies that prices may start moving upwards now. Now almost every trader knows about the doji, but I am not too fond of them and I don't use them often. The complete opposite of the doji would be the Marubozu candlestick. This kind of candlestick has no wicks, it is all body. So the green body candlestick means that buyers rule and the red body candlestick means the sellers rule. Now these kind of candlesticks are a clear indication of where the market is headed over the next few candles. Next up, the hammer. Price opens right about here. Then sellers push the price downwards. Buyers step in and push the price back upwards. But that's not all. The buying pressure continues such that by the time the candle closes, the prices move in the green direction and the body is green in color. So on here, the price opens, sellers push the price downwards, buyers push the price back upwards, but by the time the candle closes, it's still in the red zone. It has a red body, it has a red wick. However, both of these candlesticks are bullish in nature. So this is because both of them show buying pressure. But one of them, the green one, is obviously far more bullish out of the two. And if you look more closely, you will see that the shape closely resembles that of a hammer. Now an inverted hammer is the same story as a hammer. The only difference is that price opens right about here and then buyers push the price all the way upwards, sellers come in, they push the price downwards. By the time the market closes, this is where the prices end up closing and it looks like an inverted hammer. On this side here, price opens round about here at this level, and then there is buying pressure. Buyers push the price upwards, sellers push the price downwards. It comes almost to the opening price, just like sort of like the gravestone doji, but then sellers have this extra push and they push the prices downwards, and you notice that the price closes below it opens, which is why it is a red candlestick. And this kind of candlestick is far more bearish. Both of these are bearish, but this one, the one with the red, where the sellers managed to push the price even further down, is more bearish in nature. These kind of candlesticks are also called pin bars. So you can also call them hammers, you can call them pin bars. There is a slight difference between the two, but I'll just get to that. The important thing that you need to know is that the wicks in both of these, whether it's a hammer or it's a pin bar, the wicks need to be twice as long as the body. So if the wick is not twice as long, we wouldn't call it a pin bar, we wouldn't call it a hammer. Now, as far as the slight difference between the hammer and the pin bar is something like this, right? So the hammer may have a slight, upper wick, which is hardly noticeable. But a pin bar is not going to have any wick on the lower side or on the upper side over here. So when these candlesticks appear, traders get a general idea of where the prices are going to move, and then they can place their trades accordingly. But the important thing, and the most important thing that I really want you to understand, is that we never look at just the candlestick before placing the trade. This is one element of placing that trade. We're going to look at a number of other factors. We combine and make it an entire, story before a trader is going to plunge in with his money and take that risk that is involved with each trade. Moving on, there are a lot of candlesticks that have names such as the spinning top and the shooting star, etc., etc. But I'm not going to be going through all of them in this course. What I want you to do is I want to focus on some candlestick patterns, because that is what is going to actually get you somewhere. And the first pattern that I want to go into is the pin bar pattern. So let's dive in. Pin bar formations, right? So we have bullish pin bars and we have bearish pin bars. We've already seen that in the formation of the candlestick itself. However, let's take an example. If prices are moving downwards and we have, a downward candlestick right there, we have another one right there, and this could be, 4 or 5, or it could be just 1 or 2 candles. It could also be 10 or 12 candles in a straight line going downwards. And then at one candle we have a pin bar formation where prices open, they move down, the selling pressure fades away, the sellers are not able to control the price there, and buyers step in. There's too much buying pressure, it pushes prices upwards, and it closes right about here. So this shows a lot of struggle between the buyers and sellers. On these two, it seems pretty much that the sellers are in control. Price just it just moves downwards, buyers are not able to do anything at all. So what do we expect when some things like this happen? We expect the prices are going to move upwards. So we have a upwards moving candle that should appear in most cases. There may be times where there is another struggle, sellers try to push the price slightly downwards, you may see a small wick, but what is expected is that after such a pin bar, prices are going to move upwards. Similarly, you could have another pin bar formation which is bullish, but it is a red candlestick. Notice that we can see that the body of the candlestick is, the wick is basically more than 2 times the size of the body. So whether it's green or it's red, right? So we expect prices to move upwards. The important thing is that this kind of formation is stronger than this one right here. Looking at the bearish pin bar formation, right? So we have prices that are rising, and then suddenly we have this, pin bar that is, inverted. It's, upside down. We have prices opening around about there. It goes up, the selling pressure steps in, and then it comes back down and closes in the red. So this is it's a pretty clear indication that prices are going to head downwards from here onwards. Again, this is just the first part of what we traders look at. We want to see the bullish and the bearish pin bars, but then we want to confirm this by looking at some other factors, which we're going to discuss in the next courses. Next up, we have the engulfing patterns, which will have the bullish engulfing and the bearish engulfing. So we have a series of downward candles which shows that prices are moving downwards, and then there is this bullish candle that pushes prices upwards. What we want to see is whether the previous candle or the second last candle here is completely engulfed by the new candle or not. So we're going to take the opening price and the closing prices of the previous candle, and here we can see that the range or the entire size of the body of this candle is smaller than this one. That's the first thing. The second thing is that the entire body needs to be completely engulfed. So if the opening price of this candle is slightly above, and then we have some part of the previous candle that falls outside the body of the new candle, it's not engulfing. This candle in the entire body needs to be completely engulfed. That is the important thing. So whenever you see this, we expect that prices are going to go higher. They're going to move upwards. Let's look at the bearish engulfing. So we have a series of prices, candlesticks where prices are moving upwards, and then we have this huge candle that, it's a red candle, bearish candle that moves downwards. Again, the same rules apply. We need to make sure that the previous candle, this one here, is completely engulfed by the body of the next candle. The important thing is that whenever this happens, it's going to send prices downwards, or at least that is our expectation. We want to make sure that the wicks are not involved in this decision making process, right? So it's only the bodies that we're looking for.